It's one of the closest things to magic that we do. I always say, I think I've said this in almost every webinar we've done, and certainly on calls. I'm a lawyer. I tend not to speak in absolutes. I try to be careful about this stuff. Nothing's a no-brainer, and nothing's perfect, and nothing's actually magical. This is pretty straightforward, and you can draw a direct line from not a lot of money to a lot of money tax-free. It's an easy win for most families, which is again why it's often the first stop. So I said I'd jump to this. How do you do this, right? You set up the trust, you put a life insurance policy in there. Typically, it's going to be a new life insurance policy, not one that you already own. You put the insurance policy in. Well, now you have to pay the premiums for the policy, just like you would any life insurance policy. How do you do that? There are a bunch of ways here. The bottom line is you can't pay them yourself, right, from outside the trust. You could, but it would be administratively a nightmare. It would be not optimized. There's no good reason to do it. So that's not what we do. Instead, typically what you do is either pre-fund the trust with cash or maybe an income-producing asset that will itself pay for the premiums. You can do that at the outset, and as a result, you get that money out of your estate, and then it just pays the premiums. Or you can fund the trust every year, just with a cash gift to pay those premiums. It's entirely up to the grantor. It's very straightforward. There's nothing fancy here. We just like to touch on this because it's helpful to demystify. It's very, very easy to do. You just fund the trust and you pay it. Anything? I feel like I'm maybe being a little glib about this step, but it's not complicated. Anything you feel like you can touch on, Jeff?
No, I think the one thing that keep in mind, I guess, is when Jeff talked about the estate tax exemption and that lifetime exemption in the beginning, any kind of gift that you give to this irrevocable trust or any funds that you send in are going to count against that. So you just want to be mindful about the fact that you're using some of your exemption to fund this. You're getting this multiplier effect on the future. But I think that sometimes there's a bit of, I didn't realize, I thought I'd only pay that. You have to still, document it as a gift, et cetera.
And part of that is that just thinking about overhead a little bit, often the question is, well, this is straightforward, but I've got to deal with it. It's going to be a lot of administrative hassle. No, Valur working with ARDA, but on this part, especially the Valur side, we handle that for you. We'll do your gift tax form. We'll do the filings. So you don't have to worry about this. But it's true, there's a little bit of overhead here behind the process that I described.
Yeah, but generally very straightforward. Agreed.
Yeah, that's right. Benefits and trade-offs. I think we can probably speed through the benefits here. We've talked about this. On the estate tax side, the life insurance proceeds outside of your estate, very straightforward. If ultimately you've put money in and you've used up that part of your gift tax exemption, and then the money grows and you've got $10 million in there now, that's all estate tax free. Very straightforward and the main benefit. Jeff, do you want to talk about the tax-free growth side of things, which is maybe more on your side?
Yeah, absolutely. And I'll get into a little bit more of the details in a subsequent slide. But one of the features of life insurance is that you have what's called tax-free buildup of value. So when you pay a premium into a permanent life insurance product, again, focusing on decoupling the word premium from cost. A lot of people think, permanent life insurance premiums are so expensive, they're so high. In reality, what happens is that premium goes into a policy, and yes, there are costs and fees that are deducted to be able to provide the insurance coverage, but a good chunk of that, and in many cases, particularly with PPLI, the vast majority of that premium gets invested. And so what we mean by tax-free growth is that net amount that's going into an investment account inside the policy functions very similarly to an IRA. You can invest in bonds, stocks, private credit.